Thank you very much for joining us today. And you know, in all these activities, media activities, which we have in credit engineering, once I was asked, what is my favorite rubric? So today I am in my favorite rubric, in my favorite section of credit engineering activities, because today we've got credit science. And in this section, I am guaranteed from being not the wisest man in the room, because today we have a privilege to welcome Mr. Professor Altman and Dr. Gabriele Sabato. Ladies and gentlemen, please welcome me in joining. Edward, Gabriele, thank you very much for coming to us.
Our pleasure.
Thank you.
This is about intro, and today, off the air, we were speaking with all three, and I said that I was learning credit risk on your books, on the works you did together with Gabriele. Some of the books I think was written with him, but I understand that I'm still quite young man in comparison with the credit risk modeling, because I was born in 1972, and the first model came to the world. Your Z-Score was introduced in 1968, but it was not the first. But I'm trying to walk a mile in your shoes, and it's always interesting to add historical perspective and understand how this everything happened, because I can understand that financial statements are numbers, and we can reproduce them and recalculate them into focus. But was the idea of that risk modeling is something exclusive, or was it something flying in the air, and then it was waiting for somebody to formulate that? So how this happened in the very, very beginning, because you were there at that time.
Well, thank you very much for your introduction and your invitation for today. Gabriele and I are delighted to be involved with you and your audience. And we certainly look forward to the discussion and any questions that you or your audience may have. So credit risk certainly is a subject that I've been living with for most of my adult life. But of course, the whole area goes back many centuries. It started probably in medieval times, believe it or not, when the Crusaders had to travel across Europe and into the Middle East and needed credit as they stopped for hotels or hostels or restaurants along the way. But they didn't want to carry cash with them because it was too dangerous. And so they established lines of credit early on. And of course, there was always the risk that they would not repay. So people had to do some sort of analysis on these Crusaders. Fast forward in the United States to the mid-19th century, when the country was developing and moving westward. And again, companies needed credit. And most of the analytics of that time, I wouldn't even call them models, were based on qualitative factors, not quantitative factors. Where was the company located? What sector were they in? Something about the ownership, wealth, something about the management of the company. And those non-standardized qualitative factors then died away as the rating agencies became prevalent in the early 20th century. 1909, Moody's, 1916, Standard & Poor's started formal bond and credit ratings of companies. And they, of course, utilized for the first time a large number of variables and information on the financial health of companies. And those ratings, of course, represented probabilities of default. and later on, probabilities of loss given certain recoveries. And so they established these credit metrics, which were basically univariate measures that were analyzed one at a time, usually compared to industry norms or time series movements and trends. And this was the state of the art until probably the mid-1960s. At that time, myself, independent of some work done by William Beaver on his work out of the University of Chicago, which he was looking at particularly comparing healthy and unhealthy companies to establish metrics or cutoffs of these financial variables, like return on assets, like debt equity ratios, leverage, profitability, activity type ratios. And he then published work around the same time I was finishing my doctoral dissertation at UCLA. And as you said, Andre, we developed the first generation multivariate model, looking at a number of factors simultaneously and establishing weightings as to the relative importance of particular indicators of financial health of companies. And that emerged in my work in 1967, published in 1968, of the so-called Altman Z-Score model. And at that time, to be honest with you, my objective was to establish, these metrics for assessing financial risk and credit risk, but I had no idea that this model would still be in existence more than 55 years later. And I could go into the reasons why I think it's still in existence and still used, probably, among the most used and well-known of the credit risk models. Basically, it's a simple idea. It's still very accurate, and it's free. You don't have to pay for it. And so those three attributes has made it accessible not only to practitioners, but to thousands, literally thousands of articles and books written since, which always are trying to build a better model, a better engineering, if you will, of the credit risk function. And the reason why it's used as a benchmark is because it's easy to replicate and to calibrate and to compare with new models. So over the years, we've seen, let's say, advances in credit risk modeling. Mostly, they originally started being in the area of specific models for example, different industries, specific to industries or to different countries. And these were basically variations on the same theme. And so the accuracy levels improved quite a bit if you could focus on specific companies that you were particularly interested in. So if you're a credit risk manager and most of your clients, for example, are in the retail industry, you would like a model specific to retail companies rather than a general model. And most of these models were either based on regression or logit analysis, probit analysis. These are somewhat different family of classification techniques. So the combination of financial data, mainly from either annual or quarterly reports of companies, combined with increasingly sophisticated mathematical and statistical techniques to analyze that data, gave birth to a credit culture. This became tremendously more important under Basel II, which was introduced by the BIS in Switzerland, where you're located, in 1999, and debated among researchers and banks, particularly, and became the norm somewhere in the early 2000s. And it depended on, of course, each country adopting Basel II to set capital standards for their credit operation. And the document that was finally agreed upon, while it was very heavily mathematical and analytical, still were based on models built like the Z-Score model, usually by individual banks for their customers, or a general model for the economy of different countries. And internally based models were developed, and it was like a cottage industry where consulting companies would provide their services to banks, or the banks themselves would hire people to develop their own models. Gabriele and I met in 2002 or 2003 when he was a visiting scholar at the NYU Stern School of Business, where I've been hanging out now for more than 57 years. Andre, I haven't figured out a way to get another job, so I'm still at NYU Stern. And we together decided that the one area that needed much more sophistication and much more care in credit risk modelings was to analyze small and medium-sized companies, which almost by definition are highly risky compared to large conglomerates or large manufacturing or service companies. And not only did they need careful modeling that's were different than for large firms, but also they needed to enhance the somewhat opaque or hard to find relevant data to analyze these companies. And I'll let Gabriele talk a little bit now about the modeling of SMEs and say a little bit about that, but we can perhaps go into more detail on how we approached it at Wiserfunding when we turned our theoretical models into practice, so to speak, and formed our company in 2018. So Gabriele, perhaps you'd like to say a few words about what we found in our research on SME modeling when you were visiting at NYU, and what's happened since in that area.
Sure. Thank you so much, Ed, and thanks, Andre, for this opportunity. Yeah, I mean, clearly, when Ed worked on the original Z-Score model, he was focusing on large corporates, and that was the most important part. Like for rating agencies, everyone was just looking at the credit quality of large public, most of the times, companies. The main reason was because in order to get data about these companies, they had to rely on their disclosure. And so that was, let's say, easier to find and to process in terms of this input data. I think, Ed, if you want later, it would be fascinating for you to tell a bit the story of, how much time you had to spend when you developed your original Z-Score model to get the data and to process it with the, the punch cards and so on. But fast forward few years, I would say, when we met, the question was, well, now increasingly the market is looking at small private firms. Data is becoming available, so maybe it would make sense to develop some specific models for small and medium-sized companies. That was, at that time, very much a question, I guess, a typical academic research question. And we wanted to find out the answer. And so that was our first work. We found a public database that had a fairly large amount of data on private companies. At that time, we defined private companies as companies with a turnover less than $50 million. We extracted all the financial data that we needed, and we basically created ratios, pretty much the same type of work that had done, for his original Z-Score model. And from there, just using financial ratios, we basically developed a model specific for US small companies, less than 50 million turnover. And we ran this model, we ran the original Z-Score model, and we ended up comparing these two and found out that obviously, again, a bit as we were expecting, a specific model for private small companies would perform better than a model developed for large companies. Okay, so that was actually our first study and drove a lot of attention, I must say. I remember, again, I was still a young student there, but we got a lot of attention because almost for the first time, there was a specific study for private company, for SMEs. And that word SMEs was becoming more and more important in the markets. Government, regulators, everything was, putting more and more emphasis on SMEs. So from that study, I guess we moved on and continued to research on SMEs and what could improve credit risk models for small and medium-sized firms. And so through the years, we looked at different variables, different geographies. In particular, I think in 2008, we looked at how non-financial variables could actually increase the accuracy of credit risk models. Again, very early days. At that time, in 2007, 2008, when we started that work, it was impossible to basically source non-financial information real time. So we had to go and manually look for this information and create a database and then use that database to basically feed the model. Again, something that you could do when you're writing an academic paper, but a lot more difficult to do in practice for an institution. So I guess that study was very interesting from an academic perspective, but back then was not really something that could be put in practice. Later on, I guess, a few years later, with the artificial intelligence, the ability of technology to process non-financial information, so unstructured data, this has become a reality. And that's something that, again, we'll talk about later, how we do that at Wiserfunding. So I guess just to conclude, we started from the idea of the Z-Score model and using financial ratio, and then we expanded upon that, looking at different other sources of data and type of data that could improve the accuracy. Because when we look at small companies, the reality is that they are very dynamic. Everything changes very quickly. And so you need data that can provide you an up-to-date view on what's going on for that company. And so that's really what we were trying to replicate from a modeling perspective.
Let me also chime in here, Andre, and say that when we began our focus on the small and medium-sized firm sector, we eventually were assisted not only by our own ability to analyze structured and unstructured data, but things like social media information and open banking, which started, I think, in 2017 in the UK, at least. I'm not sure if it started earlier, as well as in Europe. What we found more than any place else, actual tax information were required by all companies to be made public. And so the technology of grabbing this data from various sources was enhanced by regulation on the part of governments, where the major objective was to assist the clients, the firms that borrow money, so that they could become more acceptable to investors and to banks and non-banks for lending by creating a fintech industry. And we will go into that more when we talk again about Wiserfunding and how we started and what we found in the environment to assist us in what originally was strictly a financial model based on annual reports of companies. And now that's gone to a much greater sophistication in terms of types of data, quality of data, and how you analyze it. So that kind of brings us up to date. Let me also mention, which we didn't to this point, that the statistical and mathematical techniques that are used to analyze the data also were enhanced by mathematicians and statisticians who saw default prediction and credit risk as the major application area for their technical skills. And things like genetic algorithms and data mining, and more recently, machine learning, as well as, perhaps many other statistical and mathematical techniques that were tried by academics for the most part, but also by consultants and some financial engineers, always looking for the ability to harness the information content of those accounting and non-accounting numbers. And so the state of the art increased both in terms of data availability and modeling sophistication. Fortunately for me and for Wiserfunding, as you'll find out, the basic constructs really have not changed. We are looking for a number of variables, each one with appropriate weightings to enhance the information content of those numbers and provide guidelines for lenders, for banks, for investors, and of course the direct lending or private lending industry has grown dramatically, as well as the need for banks. So Andre, that kind of brings you up to date. I know it's very difficult to summarize, so many years and so many different models, and perhaps we can have specific questions on them later on.
Thank you very much for that. But as we today, our today's title declared was SME lending, we are getting exactly to that. And but let's take the wider picture first, because we see that the SME lending is growing. And it is growing in a fintech environment, in the, let's say, non-banking institutions. At the same time, bigger banks are creating their own, departments, their own sections, which are involved into the SME lending. And my understanding, my restricted understanding, I'm not a scientist, I'm not an academic, I understand that, SME is quite a big part of the economy. And at the same time, I understand that this is most underfinanced part of the economy. May I just presume and ask you, what is your view? Because my understanding is that this is somehow, it has something to do with global trade finance gap, which is about $1.8 trillion based on Asia Development Bank research in 2020, if I'm not mistaken, 2017, and it continues to grow. So fintech and this SME lending is kind of economical relief for that underfinanced part of the economy. And
Yeah, I agree with that. Also,
maybe
you can add to
can add
that.
some points to that.
I think you can add to your summary of the evolution and the importance of small and medium-sized firms. And of course, Europe, I'd say the SME sector is even more important than in the United States, which has many more large firms than most of the rest of the world. But in Europe, the regulators and banking industry realize the importance of SMEs. But let me point out also that while we all know about the importance of small and medium-sized firms to an economy in terms of providing jobs, in terms of GDP contribution, in terms of number of entities, at the same time, it's quite clear that when you have a credit difficult period, like we are in today, particularly in Europe, and particularly in the United Kingdom, but also throughout Europe, usually the banks in particular are either forced by regulators or their own internal decisions to cut back on lending to small and medium-sized firms, the so-called credit rationing impact. And so SMEs not only are important and need financing, both traditional and alternative financings, but in times of financial stress, in times of recession, higher interest rates, inflation periods, like we're realizing today, those same firms that need the financing are the first ones to be rationed out of the traditional markets. And we feel at Wiserfunding and our research is that is not only unfortunate, but it doesn't have to be the case if you have relatively accurate and confident credit risk modeling to handle distress in a difficult period, rather than simply cut back dramatically, almost by saying, no matter who you are, you're not going to get credit if you're small and a medium size, or almost like that, to, okay, ration it out, but keep financing reasonable credit risk entities. I think that's a very important aspect of the SME market. It is more volatile than the traditional large firm market in terms of changes over the business and the credit cycle. Sorry for that long discourse.
This is absolutely okay. You see, it's a great perspective, because I was just wanted to echo you that, you know, each time we see financial crisis like 2008, we recall the famous saying, you know, friends and money, where they are when you need them. This exactly the story about the banking system, because, you know, first thing the banking system does, they cut financing. So this actually gave birth to that, you know, fintech and everything, because economy requires financing. And at the same time, I understand that, you know, Wiserfunding is the company where you both are involved and you play a role in that. My understanding, you will enlarge it, is involved in that market, and you provide with SME lenders with that sophisticated modeling. But before we go forward, let me ask you a dilettante question, which, I mean, I having this opportunity, I don't allow myself not to ask. Not to go theoretically, in a very short, what is your opinion, because you are researchers, to what extent, in terms of credit risk, the future is defined by the past.
I'm sorry, you're asking the past in terms of the history of a company or the evolution?
But to what extent the future of a company, of a specific, let's say, borrower, is defined by its past?
I see. Well, yes, that's a great question because it goes back to almost all the early modeling of credit risk, where the data that we use was based on historic data. And you say the past. Well, I've always felt that you want to get as much up-to-date data as possible, but when data was not available on a real-time basis on financial health of companies, we were left with using either annual or quarterly reports, which were reporting past activities of the company. And we wanted the model based on data from as close to defaults or non-defaults as possible in building the model. And then you went back in time to see how accurate the model was over many time periods in the past, and see how long range was the accuracy of the models. So past data, we think, is still quite relevant. You simply should not forget about the past and only look at the most current information, because trends in financial data are critical to understanding the change in credit risk of a company. However, you need up-to-date information, real-time information, and that's where the technology comes in to be able to grab that data, introduce it into your APIs, and process it so that not only do you have up-to-date data, real-time, but also to provide a credit analytic output very quickly and inexpensively. And this really leads us to our philosophy and our strategy at Wiserfunding. If we can move on to that, Andre. I know you were interested in that, but it's the right time, I think, to move on to that, if that's okay with you.
Absolutely.
Okay, so let me give you a little background on how we got started and why and how we've evolved since we started. So I visit quite often Italy for various reasons. Obviously, we love Italian food. We love the Italian people. But also, and my wife has a passion for the Italian language. And so I go there quite often. And I got involved in some other companies there in financial advising. And then I received a phone call one day from the stock exchange of Milan, of Italy, the Borsa Italiana. And they asked me, could I come in to talk to them about building a model like a Z-Score model, but specializing in small and medium-sized firms in Italy, and particularly those firms that were issuing a new type of financial instrument called mini bonds, small bonds. It was actually a more technical name for it that the government tried to become available to entrepreneurs, SMEs, issuing bonds directly to the public, like larger companies issuing bonds. But what the stock exchange was interested in is to have these mini bond issues listed and available for secondary trading by a select group of institutional investors. So they asked me, could I build a model? Because one of the real problems of small firms financing is the fact that these companies are not well known. Their data is quite opaque. Their data is perhaps suspect. And therefore, I would say modern credit analytics were not possible up to then. So they asked me to do it, and I said, well, I really don't necessarily have the time or the team to do it, especially with me being in New York. But let me think about it. And I got in touch with Gabriele, who after leaving NYU as a researcher, became a fairly sophisticated banker in the credit risk area for a number of banks, Dutch banks, and also British banks, Royal Bank of Scotland in particular, when I called on him. And I asked Gabriele, could he assist me in building the kind of model that the Borsa Italiana was interested in, SMEs in Italy issuing mini bonds. Mini bonds are probably 2 to 20 or 30 million euros in size, so much smaller than a typical bond issue for larger companies. And he said, well, it sounds like a fascinating idea. I don't have much time in my day job, but I can do it perhaps in the evening and weekends. And sure enough, he did a great job in analyzing. We had a very good database from small and medium-sized companies in Italy, both who defaulted and non-defaulted. I think we had about 15,000 companies in building a first-generation Z-Score model for SMEs in Italy. And we introduced it. They liked it very much. Indeed, they're still using it. And this was in 2016. And then Gabriele came to me and said, listen, since we had such good success with Italy and SMEs, why not form a company and become much more geographically dispersed and maybe even global? So I said, listen, I'm an academic. I don't have any experience running companies. He said, don't worry about it. I'll run the company. You just provide, both capital and research and consulting. So we started in 2016. Actually, we started actual operation in 2018, and we didn't even think about the name fintech. But in fact, we were a fintech because we needed more and more different types of information. And I will now ask Gabriele to talk a little bit about how the original financial statement data inputs that we used to build the first generation Italian model has evolved at Wiserfunding to now incorporate within global models. We now have models, I think more than 60 different models globally, both by country and by sector within countries, but also incorporating far more information than what we did in our first generation model for Italy. So Gabriele, if you could kind of take us from that introduction in 2018 to the present, to give Andre and the listeners a little idea of how our thoughts. But let me say one thing before Gabriele says it. What is our mission? What is our objective? And I've always said this to anyone, including Gabriele. I said, my goal is to become the standard in accurate, sophisticated models emphasizing the importance of a credit culture within the financial community in dealing with small and medium-sized firms. And in doing so, I hope, and I think I've seen some evidence, that the SME sector will become far more profitable for lenders, more efficiently analyzed and will enhance SMEs' ability to get financing. And I felt this even before knowing about the technical and regulatory innovations that took place in the last 5 or 6 years regarding SMEs. So, Gabriele, if you take us from the formation in 2018 to the present and some of our innovations and observations, I think that would fill up the the background on where we are today.
Yes,
Sure.
please.
Yeah, sure. I mean, I guess, Andrea, as you can imagine, at the start, obviously both Ed and I were kind of expert in finance, and almost like every time you start a fintech, you've got this idea that you may be an expert in finance, but a bit less in technology. So we kind of guessed, let me say, what technology could do for us, but we didn't know exactly. Okay, so that was the start. We were coming with this data. We saw that data was becoming available, not just financial data, but also unstructured data. There was a lot of data around, and that data was increasingly available through APIs or different type of way to access this data. We had to create a technology that could process this data real time, because you see, that's the difference between an academic study and then going into a business. The accuracy of the model is relevant, absolutely, but is nothing if you can feed that model real time. Okay, so that was the challenge we had to face. Find the right trade-off between accuracy and ability to run models real time, because that's what the market needed. Real-time insights on private companies. It's the same if you go into the Bloomberg terminal and you want to check what's the price of a share. You want to know it right now. You don't want to wait a day, a week to know what the price of that share is, right? And that was what the market was asking us. So I think we intercepted that gap in the market. We started right away to work on a technology that could help us to source data real time, different type of data, financial, which is structured data, it's easier to process, and non-financial data. That was what we added there. So variables looking at corporate governance, ownership structure, legal events, social media engagement, news. All this is data that is available out there. I think any credit analyst would go today in Google, and the first thing would Google the name of the company they are assessing, right? And that simple things would return a lot of information on the company. First of all, their website. What do they say on their website? What they really do? What type of accreditations they have? Who are their clients? Do they have a LinkedIn profile? How many followers they have? How often they publish? Who owns that company? Is that many different owners? Is there big shareholders and smaller shareholders? Angel investors? Is that a private equity backed business? Is that a family business? Corporate governance, how many directors they have? Do they have non-executive directors sitting on their board? I mean, these are all things that any credit analyst would be looking at when assessing the credit profile of a company, right? What we wanted to do was to basically automate this process, remove the subjective element, because inevitably when a human like us looks at a company or looks at anything, pretty much will be applying biases, and that's normal, because we are selective in what we look at. We only able to focus on one thing on a univariate level rather than multivariate level, considering correlation between different aspects. So we wanted to build that technology. We wanted to be able to process all this information, financial, non-financial, and macroeconomic information. So the context in which the company operates, country, sector level. That was the idea. And we tried to build a technology that could do that. And in a couple of years, we managed to do that. So in 2019, we actually started with, like many companies, a so-called MVP, which is, a very simple kind of platform just to test the business model. And that's what we did. Very quickly, we acquired about 12 clients. Then obviously the COVID period was kind of a push. The start was something that we were like, what's going to happen now, but was kind of a push because, as you know, everything became digital. And so what we do at Wiserfunding goes very well with the digitalization process. Okay, so digitalizing the lending process means that you want to become faster, you want to become more efficient, and everything we do at Wiserfunding goes exactly in that direction, providing a
I think we need
large amount of insights. Yes.
Please go on, because you were
sorry
for a second.
Okay.
It's not about you.
So no, that's what I was saying. Processing a large amount of data and providing insights that can be consumed quickly by the credit analyst. That's really the focus. And again, any company today, any lender, as you mentioned, can try to go and source the same data we source. But again, having to build that technology and process all this data, you need to also have the right know-how to know how to extract value out of raw data. And that, I think, is the biggest IP that we have built at Wiserfunding.
And it's important to point out, Andre, that so our models have really three components to it: financial data from annual or quarterly reports, non-financial data processed through AI, as well as our own technology to incorporate these variables numerically into a second module. And third, we also input information from the macro environment of the economy, the sector, related to the SME that we are analyzing. And from those three modules, we end up with a credit score. And that credit score, it's very important to take a score and map it to a bond rating equivalent. Because everyone knows what a bond rating, at least the hierarchy, stands for. So if you can take a scoring system and transfer it into a rating equivalent, you then have the basis for establishing sophisticated probability of default and loss from that bond rating equivalent. And from technology that I've developed over the years, we've worked on a concept of mortality rates of companies, which is key to a bond rating equivalent, leading to data, empirical data of that bond rating equivalent over time in terms of defaults. Fast forward to what the client receives is a standardized report, but custom made to the particular size, sector, and country of the client, of the SME. The client, of course, is a financial institution or non-financial institution that is interested in monitoring the health of the client, of the SME. And I can give you a few examples of the type of company beyond a traditional type of lender that is interested in that information. Recently, we have entered into a very exciting market of export-import government entities throughout the world that have as their main objective to guarantee or insure or analyze companies so that they can more efficiently and be financed more effectively in terms of their export-import operation. So it's not only a bank or a invoice finance company that would be analyzing SME health, but also government regulators, agencies, whose objective is, of course, to assist the SME sector to grow and add to the economies that they are located in. There are many other users of our model, and the fact that these companies now are global. And so in order for us to be a global fintech, we have to have models for example, India, Africa, Asia, as well as Europe, where we started.
Okay, so that my presumption when I was reading your books and understanding that, when we analyze when the company has a portfolio, it's never a question of having one unique great credit risk model. It's normally a question of model set for different types of enterprises. If, for instance, a multinational company or just a company who is trading with or delivering its products to different types of customers, like I had in my practice during my corporate time, I had a retail customer and the chain of hotels. We cannot use the same formula or the same approach to analyze them. We need to have a model set, and this set will be somehow unique for the portfolio. And
exactly,
this is exactly what you provide for. You provide different models for different types of customers. So all different types of creditors. I think what you just said, including trade creditors, could use these models to analyze their customers.
Absolutely.
That's the idea of Wiserfunding. Well, this is great. And if I understand from other side, my understanding is that you use a direct source of data. So actually rating of every single borrower or customer is updated in real time.
Correct.
Based on the new information coming, so we can track what's going on. And actually, to my experience, because I always have to put on two caps. And that's what I was thinking about. Please correct me if I'm wrong, because the process of credit granting is divided into two sub-stages. We analyze credit, and this assessment is to be as objective as possible and without biases mentioned by Gabriele that, importance of customers of customers should not be involved into the risk assessment. And then we take decision based on that. So, and it's actually, these processes are interdependent, but again, the more objective the creditworthiness assessment, the better credit decisions we take. And that's what you serve to.
Absolutely.
In Wiserfunding.
Yeah, absolutely, Andrea. And let me just say, it's not just origination, by the way, because what you're describing there is the typical origination process, right? Where a new customer comes to a lender, to a trade credit for a credit insurance. But the reality is that then that client will remain there. And this is the problem. SMEs are small at the end. Okay, so they're riskier, and obviously the type of margin needs to be appropriate to basically cover for that type of risk. And so it's key that at origination, we look at what's the appropriate credit limit, what is the appropriate like risk-based pricing, and these are all metrics that we can provide. So it's not just the score, it's the probability of default, the expected loss, the credit limit. These are the insights that we can provide at origination stage. And then later on, you want to continue to monitor that client. You want to make sure that that client stays in good health so that you can hopefully offer new products, increase limits, lower pricing, and customize an offer to that client as much as possible. And these are all things that you can do with our platform. So really trying to support our clients through the entire credit cycle.
I do believe monitoring is greatly important, and that was my mistake not to mention in that, because you see, I've seen many examples, and thanks to what was written, thanks to Edward, who wrote that in his book, that there were signs of coming bankruptcy of Enron, but neither of lenders, neither of creditors withdrawn their facility. I think this is the greatest learning we've got about credit management, because first of all, we need to monitor our customers, and then just having, that's what I say, you can hire me, you can hire Gabriele, you can hire Edward as credit analyst, but yeah, this is, I think, this list linked to the credit culture. But if the result of this analysis or whatever sophisticated model is not leading to a decision making, this leaves this makes all of this job absolutely not helpful for that, because credit decision is to be taken, and this leads us to the idea of credit culture and credit awareness. And since you mentioned the macroeconomic data, and I always interested to know, I mean, listening to the lectures of Edward, and if you can just update us about the credit cycle, because from my understanding, this is the great idea. You noticed in your researches that we've got, let me try to explain that in the simplest possible terms, and then correct me if I'm wrong, that the credit cycle is that indebtedness of companies is growing till to the breaking point where we've got crisis. That's the way we had it in 2008. And as far as I understand, the new cycle is coming, and we are somewhere in that cycle. Please.
Well, yeah. Well, first, it's very, thank you for the question. It's very important first to understand and describe what is a credit cycle.
Okay.
Most people know what a business cycle is. There's expansion, recessions, crises, depressions, whatever. With respect to a credit cycle, the spectrum goes from a benign situation where there's easy credit, relatively low problems, relatively low defaults, small amount of losses to lenders, usually low interest rates, and a growing amount of debt outstanding. And that's the benign cycle. However, when things become a little bit more difficult, we move to an average cycle. So what is an average credit cycle? Well, we need historic data to calculate average default rates, average loss rates, average spreads between what you charge a risky customer and the risk-free rate, the so-called spread, and other metrics that we use to talk about the credit cycle. If things become quite problematic and defaults start rising, credit becomes more difficult to find, interest rates start rising, then you have a stress cycle. And then at the extreme right-hand side, so to speak, of the spectrum, you have a credit crisis. And a credit crisis, in my opinion, is where the lending population has default rates in any year, and hopefully not for many years, but it could be many years, of more than 10% of the outstanding debt. Now, that's my definition of a crisis. There are other things dealing with liquidity, with marketability, and certainly during the great financial crisis of 2008, 2009, you had the lack of any lending going on because the interest rates that were required just were not possibly to be met by companies or governments or whatever. And you had a static credit situation. So that's the spectrum of a credit cycle. Where we are today, well, in my opinion, we are at an average credit cycle period in the United States, perhaps a little bit more stressed in the UK and other countries in Europe, not all of them. What I mean by average is that the default rates on leveraged finance products like high yield bonds, leveraged loans, direct lending are more or less at the historic average. And for that, we need historic data. And I have data, and there are data available going back maybe 40 or 50 years in terms of default rates, etc. I was very fortunate to be asked by a major investment bank in the United States, Morgan Stanley, in the early 80s, to analyze a new market called high-yield junk bonds. And that market, while it was very small at that time and now has grown to perhaps $1.6 trillion outstanding, and leveraged loans a similar amount, and direct lending a similar amount. So we now have something like $5 trillion of leveraged finance in the United States, and certainly growing in many other countries. You have a laboratory for analyzing historic data. And so we can look at a default rate of high yield bonds, for example, somewhere between 3 and 3.5% as average for that risky sector. Now, what I also look at, and this is relevant to today, not only where we are today, but what has been the trend over the last several years. And when I see the default rate being very, very low, a benign period, rising over the next several years to an average or slightly above average level, as we are today, if there is a chance that the macroeconomy will go into a recession, or at least a big downturn from the growth rate, that GDP growth rate that we had been experiencing, this is usually, almost always, a harbinger, a forecaster of a stressed cycle coming. I'm not saying a financial crisis, but a stress cycle will see default rates going 4, 5, 6, 7% of the outstanding debt in a particular type of instrument, like high yield bonds, leveraged loans, direct lending, and more downgrades throughout the rating spectrum. Now, let me end by saying something about the macroeconomy. So if you have an increasing trend in defaults, a tremendous amount of debt in the system already, as we certainly have, both corporate and sovereign, and you have the possibility of a recession, which up to now the United States has been resilient and avoiding a recession, even though many so-called macro forecasters, which I'm not, have called for a hard landing or even a moderate landing in terms of economic recessions. Now they're probably saying, well, we should have a downturn, but maybe not a recession, especially as inflation stays high and interest rates stay high. Well, you know, if we do have that recession, there's no question in my mind that default rates will continue to rise and go from average to stressed. And let me end with a little known fact that I've just analyzed this last couple of days. In the United States, for the first 3 months of 2024, we have more corporate Chapter 11 bankruptcies than any 3-month first quarter period going back as far as the great financial crisis. In other words, even though the economy is still perking along at a fairly decent GDP growth, and the market is expecting 3 interest rate cuts, reductions by the Fed before the end of 2024. Even with that, we are experiencing more bankruptcies. And obviously, the reason is some industries are not doing as well as the overall economy, and a large number of small and medium-sized firms cannot exist very easily in this high interest rate, somewhat difficult period. And so the number of SME bankruptcies has spiked dramatically in the US. Just in the first 3 months of this year, we have something like 1,800 Chapter 11 reorganization bankruptcies. And the typical 3-month period over the last 15 years is something like 1,200. So between 40 and 50% higher than the average, and much higher than 2023, which already was a difficult year. This has not shown yet in the spreads required by investors. For some reason, investors, maybe because interest rates are high enough for their threshold, have not required increasing spreads between the risk-free rate and what they charge risky debt issuers. And even with the increase in bankruptcies and defaults, the required rate of return of investors is still below the historic average in terms of spread over the risk-free rate, which I'm scratching my head wondering why. Does the market know something that I don't know? Or is the market just becoming too blasé about credit risk in this somewhat benign cycle that we were in until last year, over the last, say, 7, 8, 9 years in the US, shorter in Europe? So to conclude, Andre, we are average in terms of the credit cycle, but in my opinion, trending toward stressed rather than becoming below average in terms of the credit cycle.
Well, thank you very much. I just wanted to, because I mean, I was trying to understand. I'm not as brilliant at math and as the macro in the market and at macroeconomy as you and Gabriele, but my understanding, my limited understanding, is that it looks like creditors provide more and more financing as long as the economy is going well. And then this leads to the higher risk taking. And companies take more and more and more and more risk until they hit their head against the wall, and then they start to become more let's say, more accurate in terms of risk taking because they got bad experience, and there's everything is, and then this causes a recession. So I was trying to understand, maybe it is too simplified, so correct me if I'm wrong, but it's like this risk taking or increased risk taking is actually each time leads to the recession because of default rates, and default rates are causing the supply chain cuts, and all these chains are cutting, then the economy is slowing down thanks again to that, because of that enormous risk taking.
Well, it is kind of interesting and almost ironic, Andre. Most economists would say that defaults basically should be coincident or lagging indicators with respect to the business cycle.
Mm-hmm.
In other words, when you have a recession, you're going to have a lot more defaults. But what we found is, while that's true, we found that the trend of default rates is actually a leading indicator of economic recession. And I have data and charts to show that very clearly in a recent paper I wrote on where we are in the credit cycle.
Mm-hmm.
And I'd be happy to share that, with you or with any of your
we can share with audience. We can share with audience so everybody can read it. I would be happy to distribute it together with the record of today's event.
Sure. Anyway, that's where I think we are now. The big unknown, of course, is what will be the resiliency or not of the economy in this more challenging interest rate and inflationary environment. And so far in the US, somehow or other, the consumer, particularly the consumer in the US, unlike China, which is having a big consumer expenditure problem, has bolstered the GDP much more than most macro forecasters had anticipated. But now, maybe that's beginning to lag a little bit or taper down, because a lot of the savings that were built up during COVID have been exhausted by individuals.
Mm-hmm.
The COVID period is kind of interesting in a sense that we had very few defaults because the governments in many countries anyway subsidized companies or had a moratorium on interest rate payments in certain countries and certain sectors. And so that gave the impetus to build up debt rather than reduce debt during a crisis. And so we have a huge amount of corporate debt now in the system. It had started even before COVID, but it just became exacerbated during the COVID period.
Because we had a question about the COVID period from our audience, and it was really interesting because I was expecting that. I was listening to your lectures because the COVID is supposed to be dramatic situation for everything, but how, if I can see the question from our audience correctly, just give me 1 second, please. The question, I cannot see that question anymore, unfortunately. So the question, how the COVID changed the risk assessment, and was there any, whether or not the COVID made or brought any change to the way we need to assess the credit risk of our counterparts?
Well, it's very clear what happened. And by the way, it's not just with respect to credit risk and defaults. It's also with respect to another phenomena that I have a recent paper on, called zombies, corporate zombies,
Mhm.
which are insolvent companies that somehow continue to live on. During COVID, unlike any other crisis that I've ever seen, instead of risk reduction, risk aversion on the part of investors and companies, just the opposite happened. We had more high yield junk bonds issued in 2020, 2021, and into 2022 somewhat than any year ever in the history of that market. Close to $500 billion of new junk bonds in 2021 and 2020. And this was in the face of a dramatic reversal in economic output and recession concerns. And so the reason for that was very easy to understand, is that central banks provided dramatic subsidies in the form of reducing interest rates, and in many countries having negative interest rates from the regulator, and also fiscal policy on the part of many governments pumped enormous amount of funds into the system to support the economies during the COVID crisis. At the same time, of course, economic output dropped dramatically in 2020 and 2021. A little bit got better, but not yet. And in some countries, like China, didn't get better until 2023 in terms of lockdowns and the like. So you had, these countervailing forces. You had recession, you had difficult outlook, you had companies stopping operation, hotels and travel and new vehicles, etc., came to a halt. And yet you had very few defaults. And the reason why is that banks, on the urging of governments, had moratoriums on many companies paying their interest. And in some countries, you probably know better than I do, because it was mainly in Europe, there was a moratorium on bankruptcies. You couldn't go bankrupt even if you wanted to, except if there was fraud involved, or it was very difficult. So you had this, and so what we found with zombies, you would expect more zombies, companies staying alive artificially, even though they were insolvent and inefficient. So you would expect more zombies. But at the same time, in the early part of 2020 anyway, you had a big increase in large firm bankruptcies, not small firm, but large firm. And this led to a reduction in default rates, more bankruptcies. And when you have a bankruptcy, the zombie company is no longer a zombie. It goes out of existence. And so the data was kind of weird to look at. And the final conclusion was that the amount of zombies in the world, and particularly in the United States, was about the same before and during COVID. Most people would expect the number of zombies to increase a lot, but it didn't. We had these, countervailing forces. But there's no question that one of the byproducts of COVID was a dramatic increase in leverage in the system. And now, when those supports by the central banks and governments are no longer available, this puts a lot of stress on the corporate sector. So maybe there are some other questions that you or your audience have.
We have other questions, but to finish with this, coming back to the corporate failure book, you say that most part of bankruptcies are coming 2 years after the crisis. So since the amount of zombies in the economy and in portfolios of companies and portfolios of lenders is increasing, we are getting to that crest of the wave where,
Well, yeah,
down
that's
nearly every
possible.
day. That's kind of highly possible. You see, we've got quite huge interest to what was said by you and what was said by Gabriele. So I got question I will ask both of you to ask it. It's about non-financial, or what is called one of the commenters, like soft factors like management, business model, business size, and all that non-financial indicators of credit risk. I just what are the I will a little bit transform the question, which will be the last one for today. May I just ask, what is the proportion of financial factors and non-financial factors in terms of predicting of, in terms of default probability and in terms of credit risk? And if you can highlight 1, 2, or 3 major non-financial factors, which are the most, let's say, indicative or most transparent.
Yeah, I can answer that, Andrea. I mean, we have seen since actually our original study in 2008 that non-financial variables can add 20 to 30% to the accuracy of models. So it's a big increase. Okay. Now, every time you're looking at non-financial factors, the question is always how many of them you're going to find, right? So the missing could be quite high. And that's why at Wiserfunding, we use something that we call dynamic weights. So the module 2, so the one that processes non-financial information, the weight of that module will increase or decrease depending on the amount of missing information we find, okay? So that's really important. In terms of examples, again, I think for the first time, we've been really, I would say, the pioneers of using corporate governance information. I think that's so important. There is a lot of literature out there on corporate governance for large corporates, but very little about SMEs. It is as important as for large corporates. So the size of your board, if you have non-executive directors, the experience of the board members, the composition of that board and how does it operate, how many senior managers you have, so the structure of the company, all this information on corporate governance are absolutely key. As you can imagine, the more structured is a company, probably the more resilient will be to difficult times. Okay, so that's one. Ownership structure, again, very important. Legal events, or what has happened to that company previously. Marketing spend, so social media engagement. Very often today, you would see companies that are running into troubles to start cutting that spend, and so their engagement on social media starts to decrease. So these are all kind of alternative data or soft information or non-financial information, as we call it, that can really add a lot of value in credit models for SMEs. And that's why we use all of this information at Wiserfunding. We process it, we use it into our models, but we also provide this data to our clients so that they can get an idea of what exactly is happening and why we come up with a certain type of scoring, rating, or probability of default.
Thank you. Do you have something to add about that?
Well, I would like, not only, maybe I'm not adding, but I'm asking Gabriele a question as well. But just yesterday, I had the pleasure of listening to an internal research seminar at Stern, NY Stern, and the subject was open banking. And I've heard Gabriele mention open banking as another data source beyond the tax records, the credit bureau information, and the unstructured qualitative data that he just mentioned. So I guess I could ask Gabriele, to what extent are we using open banking information, and how does that factor into this question that Andre has asked about structured or unstructured data?
Yeah, thanks, Ed. Yeah, absolutely. I mean, open banking has been around now for 5, 6 years in Europe, and increasingly is becoming a reality in many other parts of the world. So it's key. It's this ability to basically access information from current account, individuals and companies. Now, one very important element is that you need their consent. Okay, so this is not public information, just to be clear. No one is sharing it, sharing your bank information without your consent. But once you as a lender manage to get that consent, then you can access the bank account information, download all the different movements. Now, as you can imagine, again, this is a typical case where what you receive is an avalanche of data, right? You can expect all the movements on your current account. The first thing, obviously, is trying to categorize that. So what is an expense? What was that expense? And for company, this is extremely hard, let me tell you. So on consumer, we've seen some success, but almost all categorization we've seen around in the market are struggling still struggling. I'm sure they will get better and better for companies. Okay. Once you get that, again, this data could be helpful from a credit perspective because obviously it's up to date. You can look at balances and how these balances have been consumed, limits. You can look at cash flow real time. So there are 2 or 3 variables that we have created and added to our models. Not always is possible to source this data. Again, you need consent. That consent is still very low in Europe, but it's improving. And again, categorization is a big element that needs to improve to allow to increase basically the value of this data. When that happens, I think this type of data will become very valuable.
Yeah, ironically, by the way, maybe not ironically, but certainly, unfortunately, open banking is still a dream that has not come true in the United States. Up to now, the lobbyists have done a great job in keeping open banking closed, so to speak, in the United States. And so those potential enhancements of the data from open banking information is simply not available in the US, as well as the privacy laws are probably negating most SMEs. By the way, in Europe, is there a limit on this requirement of open banking in terms of firm size? In other words, I heard that it was only up to 25 million pounds in the UK of companies that were available to the open banking, or is it on any size firm?
No, I think that limit is also in Europe. There is a limit. I'm not sure if it's the same 25 million, but there is a limit in size. So bigger, large corporate, but also you would expect that probably large corporates have, many multiple accounts. So it would be the value of that data would become, very limited, I think, at that point.
Yeah, but there is this 25 million in the UK, I'm pretty sure. Anyway, so that's another element, Andre, of it's not exactly non-structured data. It's just a voluminous amount of transaction data that needs to have the ability to process it efficiently. Just having the data is not necessarily going to make your models better.
Yeah, that's clear. As we just said, simplifying and wrapping up today's discussion, we can the analytics could be great and sophisticated, but if we don't use it properly, if we don't incorporate it into our decision, into our monitoring, into our view, I've seen a couple of examples. Just coming back to what Gabriele said, that I've seen companies who analyze their customers in trade credit like 5 years ago and continue to think that they are credit worthy. Well, we cannot be responsible for that, but monitoring is actually remains a key. Gentlemen, we come to the end to our agreed 1.5 hours. I do thank you very much for the privilege given to us to speak with you and to be updated about the recent development in terms of credit risk. Well, if you got like a couple of wrapping up final words, please do so. Otherwise,
just keep up the great work, Andre. If you can provide us with a copy of the presentation today, that would be appreciated. And let's stay in touch.
Let's keep in touch, Gabriele.
Thank you very much, Andre. This has been a great opportunity, and I think every time we can raise awareness about SMEs and how to improve the funding to SMEs is a great initiative. So thank you for that, and thank you also for allowing us to mention how we can help at Wiserfunding.
Thank you very much. And so, ladies and gentlemen, thank you very much for being with us. And traditionally, I wish everyone to have highest possible sales, lowest possible losses, or if I can say that imperfectly in the language of the area I live in, bon crédit. Speak soon. Thank you very much.
Thank you.